when something has gone this far historically, we would actually make the case that over the next 2 years, you're better off having a more diversified portfolio across an array of stocks rather than being so concentrated like the S&P 500 is. Have a wider array of industries and types of companies in your portfolio. We think that's going to outperform in the stock market over the next 2 years. And now is as good a time as any to start rotating out of some of those positions that have done really well.
Our next guest is Chance Finucane, Chief Investment Officer of Oxbow Advisors. Will be talking about his outlook for 2025 in terms of which asset classes may outperform, the current situation with tariffs and how they may impact markets, and whether or not the markets are pricing in higher inflation, what consumers and investors alike can do about that. Chance, welcome back to the show. Good to see you. Happy 2025.
Yeah, great to see you, David. Thanks for having me back on.
You have a slide deck that I'll be happy to share with the audience. I'd like to start with this particular slide. Interest rates are sending a message to the Fed. Indeed, the 10-year yield has been rising all throughout 2024, but in the first month of 2025, it's been falling down. But what does this particular chart show? And what message is it sending to the Fed?
Yeah, I think what we're trying to show with this chart is that the Fed started cutting rates right around the time that the inflation rate was bottoming and starting to accelerate higher. And usually when the Fed begins cutting short-term interest rates, it's because the economy is really starting to weaken and you start to see long-term interest rates either stay flat or fall. But in this case, interest rates on the long end of the curve have been rising for months. And you make a good point that they've come back down a little bit here in recent weeks. But in total, they've been rising. And we think that's sending a signal to the Fed that as opposed to trying to cut interest rates the way they have been in the last 6 months, they should really be focused on keeping inflation contained, because we do think that the inflation rate is probably going to fluctuate around 3% here, give or take, over the next couple of months, but could be heading back up towards 3.5% to the end of this year. And that's really going to make it difficult for the Fed to take any more actions to ease in their monetary policy like they may have wanted to a year ago.
When you say that the 10-year yield's been rising, you're correct. I'll show a chart on my screen in just a bit. But why has it been rising is my question. I've gotten all sorts of theories as to why the 10-year has been rising. One that has been tracking inflation, one that has been pricing in higher economic growth. What's your take?
It's a bit of both. So if it's gone up, say, by 100 basis points, maybe half of that is from inflation rate rising and the other half is from a little bit better economic growth rate. And you've seen that with some of the more cyclical sectors performing well in recent months. We would make the case that going into 2025, we actually think that it's some of the defensive sectors that really sold off pretty sharply over the last couple of months that provide more opportunity than trying to continue to pile into some of these cyclical sectors that may exhibit either some absolute or relative weakness over the course of this year.
Are you bullish Treasuries overall for 2025? In other words, do you think the 10-year is going to have more room to come down from current levels? 4.379 is my last number.
We think you're going to have to trade it and be really nimble with it. Right now, we actually recently just took a small position for us in our income strategies in the 30-year Treasury bond that we do think that yields could come down here in the short term. But we're very mindful of the risk in that and want to make sure that if any losses occur, that we keep that minimal, because the trend in terms of what we've seen since 2020, when you had this 40-year run, 38-year run from 1982 until 2020 of long-term Treasury rates falling, and now we're 4 or 5 years into the cycle going the other way, it really pays to be nimble. And I think what people should remember is right now, the short end of the Treasury curve, 3 months, 6 months, you're getting a 4.3% return, risk-free, don't have to worry about any fluctuation in interest rates, compared to maybe you can get 4.5% or 5% in a 10 or 30 year. And there might be some opportunities on a short-term basis to try and get a little bit of extra return if yields fall. But there's a lot of risk to buying and holding a 10 or 30 year Treasury for years into the future. And we are mindful of that higher risk-free rate now compared to, it's funny to think it was only 3 or 4 years ago, it was hard to even get a 1% short-term risk-free portfolio for anybody. Now you can lock in 4% easily, which makes it a lot easier to try to have a base to then try and find some opportunities for better returns than that. But you don't want to go too far out and speculate and risk a really significant loss when you know you can always fall back on an easy 4 or 5% return.
Well, let's evaluate how Trump's policies may impact the bond market. So first of all, tariffs have been bullish for the dollar every time he's announced tariffs. Whether or not he's actually followed through with that, the DXY has spiked. And so the question is whether or not a spiking DXY would lead to a rising 10-year yield or any movement in the yield curve.
Historically, over recent years, when the 10-year yield is rising, then you've also got the US dollar outperforming other currencies of major markets. So they kind of move together, and it's interesting to see it's sort of competing in terms of what you're hearing from the Treasury Secretary and from President Trump. They are thinking about tariffs, which, as you've said, as pointed out, usually leads to a stronger dollar when those announcements are made. But then they also come out and say they're really focused on keeping the 10-year Treasury yield lower. And if you're going to have a lower 10-year Treasury yield, historically, that means that the US dollar is going to be a bit weaker. So I think it's just difficult to say which direction this is really going. And I wouldn't be making a really hard bet in either direction of how this is going to play out.
Well, generally speaking, protectionism isn't great for capital markets if you, all else being equal. In theory, people should rush to safe haven assets like treasuries and gold, and perhaps that's one of the reasons why gold's been going up. I'll let you comment on that. But the consensus that I've heard is that Trump's policies may lead to a little bit more volatility given how uncertain people are about what he's going to do next. First of all, do you agree with that sentiment? And second, if so, how do you play higher volatility?
We absolutely agree with that. And we think that's the thing that's not being priced into the markets yet. You'll see it for a shock for a single trading day or even half of a trading day. If we think about the couple of big announcements in recent weeks, one with DeepSeek coming out with their AI model and what that did to some sectors trading the following Monday. And then with the announcement about potential tariffs with Canada, Mexico, and China. But by the middle of the first trading day after that announcement, it already rolled back, considering the delay of those potential tariffs with China or with Mexico and Canada that probably don't even happen now. So when we look at things like this, we do think that the level of uncertainty about where markets and the global economy goes has heightened, and yet we're not seeing that priced into financial markets yet, which leads us to really want to focus more on the risk side of the equation and the potential downside with any new investments that we make, rather than thinking about how do we maximize our upside here, or where's the real angle to generate great returns.
Right. So that leads me to this particular chart here, which is that the Mag 7 stock eclipsed entire country weights. This is an interesting title. And what you're showing here is, of course, concentration risk. But what does that mean, practically speaking, for investors? I mean, it's one hand to say that stocks are fairly richly valued, but what do we do with that information, Chance?
Our takeaway, and there's a lot of different ways to look at this, but the top 10 stocks in the S&P 500 are now 38% of the weight of that index because they've risen so high. And in some cases, we think they can still be somewhat fairly valued. So like we own Alphabet, and we think it's a pretty fairly valued stock given the cash flow that they generate. But when something has gone this far historically, we would actually make the case that over the next 2 years, you're better off having a more diversified portfolio across an array of stocks rather than being so concentrated like the S&P 500 is. Have a wider array of industries and types of companies in your portfolio. We think that's going to outperform in the stock market over the next 2 years, rather than thinking that the amazing performance of these companies, which they're great companies, but we think that the next 5 years or 10 years is not going to play out the same way as what's happened the last 5 or 10. And now is as good a time as any to start rotating out of some of those positions that have done really well, but are still kind of pricing in a very rosy outlook for those companies' future, and start moving into other areas that are more reasonably priced. And there's another chart I imagine you'll show later on that shows what happened coming out of the dot-com bubble, where things got so extended in some areas, and yet owning just a simple dividend aristocrat portfolio of companies that have a history of consistently increasing their annual dividend for 20 years or longer did just fine, while the overall index was going down more than 40%.
Yeah. I'm not sure if this is the chart you were referencing here. This not the first time tech has driven returns.
That was a different one, but I can discuss that one too.
Yeah, this is an interesting chart. So are you suggesting we're seeing a resemblance to the 2000 tech bubble first? right now?
Yeah, and let's put this in context. Things are not as overvalued now as they were during the dot-com bubble. Right now, these top companies generate real cash flow. They have good profit margins. They're good businesses, whereas a lot of what was happening in the dot-com bubble was just chaotic and kind of crazy what some of those valuations were going to. But what this is showing is that when you go through a period where the performance of an index as big as the S&P 500, 500 companies, more than half of the return in the S&P 500 the past 2 years has come from 7 stocks. When you have that much of the performance coming from such a concentrated subset of the total portfolio, these markets are cyclical. Everything in the financial markets, the economy is cyclical. It's going to revert the other direction. And so when you had this happen, where only 30% of stocks in the index were outperforming in 98 and 99, you then had a 5-year run where the majority of companies in the S&P 500 were outperforming because there was a snapback, and it was better to have a more diversified, balanced portfolio across other areas rather than being so concentrated in tech. And we think this is going to play out similarly, where the excitement about the opportunity in AI and the build out and the components and electrical equipment suppliers to data centers and the companies doing all this work has pushed the valuations of those companies so high, and assuming such a perfect outcome for those businesses, it may play out that way, but so much of it is already priced in. We actually think it's better to look other places to round out your portfolio, and we think that will hold up much better over the next 2 years.
All right, so which other areas of your portfolio should you be focused on? We talked about treasuries. Any other sectors that you think or asset classes that are the opposite of what we just talked about, which is undervalued?
Well, that's the nice thing about markets, is that you've got these companies that they're for good businesses. Their cash flow, their growth is pretty consistent, fluctuates within a certain band, but the good companies we look for tend to grow at a pretty consistent rate over time. But their share prices move in a very wide range just based off of sentiment and what people think about the future for their industry. So just recent examples of areas of, you've got consumer staples and healthcare that have really sold off sharply. Consumer staples, it's concern about weight loss drugs ruining demand for some of their products. It's people not wanting to own defensive businesses. And healthcare, it's the risk about disruption to healthcare policy in the United States, which is a risk, but we now think it's so priced in that there's opportunity there that wasn't there 6 months ago. And even examples such as the aerospace and defense business, if you look at a company like Lockheed Martin, their growth in cash flow is very consistent, about 8% a year going back 15 years or more. And in the middle of last year, sort of at the height of multiple wars going on around the world, their valuation was extremely high for its history. Now it's traded all the way back down because there's a possibility of peace in some of these wars that are happening in other parts of the world. But if you're just looking at the company, their growth rate's pretty consistent, and that just pullback in price off the sentiment gives you an opportunity to start a position. And that's the type of thing we've been looking to do across a number of industries.
Do you think gold is fairly valued, overvalued, or undervalued right now at new all-time highs?
Well, we've owned it for years, and it's pretty remarkable that it's gone up 40% in price in the last 12 months. I don't think anybody expected that. We think it could keep going higher. If it gets to $3,000, I think it's something that both that gold position, and we own a number of the miners and gold royalty businesses in our clients' portfolios. We probably ended up trimming some of those positions, just being mindful of the fact that it's run so far so quickly that it might need to take a breather for some time. But it's one of those core positions that we always want to have some exposure to, just because it can protect you in chaotic environments. And it goes back to that idea about uncertainty increasing and more volatility happening around the world. And gold is something that we think is able to generate a good return over a long economic cycle at a fraction of the volatility of other asset classes.
Interesting. Well, let's take a look one more time at the bond market. This is an article I want you to address, please, Chance. So Elon Musk says he's teaming up with Jamie Dimon to convince the bond market that what he's doing is good for U.S. debt. So he's going to do a live talk with Jamie Dimon later this week. In a Spaces event live streamed on X, Musk said that the talk would be aimed at convincing bond markets that his DOGE cost-cutting initiative should instill confidence in U.S. debt. It's reported by DOGE officially that $1 billion is saved every single day in government waste. And so if that is indeed true and the government is spending less money on certain expenditures, does that have any impact whatsoever on the bond markets?
Yeah, I think it would. I mean, in theory, I think the goal is to bring down the deficit that the U.S. is running right now and trying to get a handle on our fiscal spending. And so if the government's able to spend less and that deficit as a percentage of GDP comes back down, I know the Treasury Secretary has targeted a deficit of 3% of GDP, which would be a significant improvement over what's been recorded in the last few years. You want that deficit to come back down to a more contained number, because if we end up going into a recession at any time, it's not about a prediction, it's just recessions cause that deficit to widen. And so you want to make sure that your fiscal spending is in line with your GDP so that you have some room if it spreads out in a bad time for your economy.
And how significant is the trade war in regards to stock market performance? Take a look at this piece of research here. In 2000, the U.S. was the main trade partner for most countries in the world. In 2020, China was the main trade partner for most countries in the world. 41% of revenue from the S&P 500 companies come from abroad. And so tariff threats, let's go back to that. If we do have less trade with other countries because of higher import costs and retaliatory tariff measures, what would happen to earnings? What would happen to S&P 500 margins? Would they find another way to get around? Are you confident that the large caps would find other ways to maintain their margins, or not so much?
It would be problematic. So just to give an example, because I've seen this happen, I started my career covering all the consumer staples businesses. And so like a beer company, Anheuser-Busch InBev, there can be a country that decides to increase the tax on alcohol. So let's say Brazil decides to increase tax on alcohol. What AB InBev, whenever that would happen, is they would just 100% pass through the tax onto consumers. So they will take a hit on volumes because now the price has increased and consumers are going to buy less. But that's going to be what you end up seeing is if tariffs do start going through, the companies trying to sell their products overseas, they're going to have to increase prices, which will hurt their volumes. It'll end up hurting their earnings and will end up being inflationary for consumers. So it's not a good thing. It would say the big risk is retaliation back and forth that starts to spiral and escalate. And that's the thing that you don't really know yet. And we're not trying to make a prediction on what tariffs are going to be put in place. You already saw the example where there was some tariffs that were put in place with China, and China's come back with some things of their own. And then what happened with Mexico and Canada already seems like it's not really going to be anything. So it's difficult to forecast. And that's why we're just trying to be very mindful of what it is we're paying for the riskier assets that we do want to own in our clients' portfolios. And we just keep coming back to the same 2 or 3 points, but it's just really be mindful of what is your downside. If you own a stock or it could be exposure to a commodity or something like that, really look at the cycle over the last even 10 years and how far has it traded down to there's been 3 or 4 difficult times for risky assets, not even including the great financial crisis. You've got 2011, you had a hiccup in the early part of 2016, you had the end of 2018, the pandemic in 2020, and then the second half of 2022. Where did your risky assets trade at those points in time versus where it trades on valuation today? That's your downside. And that's not even getting into if the earnings take a hit. And for us, we're really focused on trying to buy into businesses that have very consistent cash flow histories and then try to mitigate if there is some unexpected things that happen, they're going to cut into that.
And we've talked about consumer staples. What about consumer discretionaries? Take a look at this story here. Private payrolls expanded by 183,000 in January, topping expectations, ADP says. ADP says company created net 183,000 jobs, slightly more than the 176,000 in December. We've had a pretty good jobs report in the last month. BLS also reported similar outperformance relative to consensus expectations. And so the question is whether or not consumer strength will be a theme this year and whether or not consumer staple stocks, discretionary stocks rather, will do well as a result. What's your take?
Well, right now the labor market's holding up. It's slowing, but it's still holding up okay. And we're mindful of if that's going to weaken further, but it's really case by case. The consumer discretionary area really, there's a lot of sub-industries. You're going to look at O'Reilly Auto very differently than how you're going to look at Nordstrom. You really need to pay attention to the sub-industries and retail as much as any other industry in the entire market you could choose from is not an area where there's a regression to the mean. If a company is getting stronger, it will keep getting stronger. If a company is getting weaker, it's going to keep getting weaker. So you really want to try to stick to the areas that are reporting good results and that tends to just compound on itself.
Yeah.
So there's examples like the home improvement retailers or the online travel agencies, the auto parts retailers. There's some areas that we're kind of just holding the positions that we've had in recent years. We're not trying to add a lot within consumer discretionary. We'd rather have a better margin of safety before we increase our exposure. But like you said, things are holding up okay. So we're not in a rush to get out of what we've held for anywhere from the last 2 to 5 years at this point.
Okay. And finally, let's talk about oil and gas. Are you bullish in this sector? Secretary Scott Bessent wants to drill more, as you know, but I'm just using ExxonMobil as an example here, but it doesn't look like Exxon and a lot of other companies are taking that particular piece of news well. Since the inauguration of Trump, actually not even the inauguration, since the election win of Trump, Exxon's just been going on a downhill spiral and then just recently consolidating. You would expect news like we want to drill an additional 3 million barrels a day to be bullish for oil companies, but I guess not. What's going on here? Do you have a view on this sector?
Yeah, yeah, it's drilling more increases the supply, and any commodity, it's about the relationship between supply and demand. So if there's significantly more supply coming online to be sold without the equivalent amount of demand growth, then too much supply, the price is going to go down. And that's the problem. We wouldn't say that it's going to really kill the oil price, but it is going to keep it range bound. So I think for anybody investing in energy, and we've got exposure to energy businesses in our high income strategy and our long-term growth stock portfolio, you want to make sure you've got exposure across an array of sub-industries within energy. You want exposure to the oil market. You want exposure to the natural gas market. You want to own pipelines along with some exploration and production businesses. So it's not something quite as simple as just having 5% concentrated just in Exxon or Chevron or something like that. And so for us, we really like continuing to own the pipeline businesses. They generate very consistent cash flow, pay out a very good dividend, and it's less dependent on the fluctuations in the underlying commodity price. And then the natural gas area has been a good place to be just because of the increased need for liquefied natural gas around the world. And actually, some of those stocks have gone so far that we probably need to be trimming or selling some of those just because they've done so well. And use that sort of diversification to give yourself more at bats to try and hit well within that sector.
That's great. So let's follow up on what happens then with the energy sector in a couple months. I like to see how Scott Bessent's plan actually works out. Finally, you've mentioned to me offline that several risks could perhaps take huge chunks of valuations out of the stock market, and perhaps it's already so richly valued that any bad news would bring volatility. So could we just maybe think about some of these risks, how they may materialize, and so we can, at least as investors, mentally prepare when they happen?
Yeah, like let's just start with the DeepSeek news and a group of a Chinese firm coming out with an AI model at the fraction of the cost of what's being spent by some of these huge technological companies in the US, and yet having an equivalent amount of effectiveness in their AI model. And what was interesting about the news was it seemed like all of the players involved in this space kind of used the news to double down on their own biases or whatever their opinion was on how this is all going to play out. And our take is it's still way too early to know what's going to happen. You can make the case it's positive for the hyperscalers like Amazon, Microsoft, and Google because this is going to accelerate the adoption of AI and you're going to need the cloud. Or you can make the case that the fact that this is becoming cheaper to produce, and you may only need it to use on your iPhone. You're not even going to need any data centers or cloud, would be negative for them. It's too early to tell. So what you're looking at when you're looking at the share prices of some of these businesses that have really taken off for the moon in the last couple of years is what's priced in, what's the growth rate that's expected. And it's NVIDIA as a good example, but it's even suppliers to data centers. It was interesting to see which industries really sold off on that news. And if they're selling off like that, in our opinion, that means they're overvalued to begin with and pricing in a perfect scenario for their business trajectory. And we just don't want a part of that because we think it's way too unknown as to what's going to happen. And if things break differently than what's priced in, they're going to come down a long way. If you look at the history of NVIDIA, fantastic company that's done amazing things, but when they go through a down cycle, their share price falls by at least 50%. So it peaked at around 150. It could easily fall back down to 75, and that would just be in line with its normal swings. But I don't know that people are thinking about that.
Are you positioned for less geopolitical volatility, given that the Gaza war has already, there was a ceasefire, though it's not really being respected, but at least Israel is going to the negotiating table with Hamas. Similar situation with Ukraine. Trump wants to make a deal with Ukraine and Russia. And so the underlying theme is just de-escalation of current conflicts. And to the extent that it impacts markets, it could be bullish for either risk assets and or bearish for safe havens like gold. Is this something that you're looking at?
Yeah, I think the difficult part with such a complex environment as the global economy is you've got to push and pull. So there's this possibility of peace in some of the major wars going on around the world. But like we just discussed earlier, you've also got discussion about tariffs, which could be a problem for just the running of the global economy. And how do you weight those two together? So it goes back to the same points, but like we're looking at what's priced in, we're looking at the high valuations in the market. And it's not just stocks. If you look at the spread on what you could get on a junk bond compared to a treasury bond, it's in the lowest 2% of readings in the last 40 years. Same thing with an investment grade corporate bond. And when the spreads are that low in the bond market, historically, it's not great returns for risky assets over the next 5 years. You're just not getting enough of a premium there to make it worth your while. So it's less about us trying to predict what that's going to mean for financial markets if there's a decrease in geopolitical tensions. It's more about what are we paying for certain assets. And with where things are at currently, we're just trying to stay pretty defensively positioned. And there will inevitably be a time that things end up looking a lot like a better opportunity for some more aggressive picks in the market. But right now, that's not it.
All right, Chance, excellent analysis. Thank you for your breakdown of the markets. Where can we learn more from you and follow you and your work?
Yeah, you can look up our team at oxbowadvisors.com or look up our YouTube channel at Oxbow Advisors.
Okay, we'll put the links down below. Take care for now, and we'll speak again soon. Cheers.
Thanks a lot.
Thank you for watching. Don't forget to like and subscribe.